Happy to be here, everyone. Making sure you can see my slides taking high probability Knoxville trades. I think you can see my slides all right. I'm hoping that's the case. And I'm glad to be here. Thanks for sticking around, everyone. I was recently in Knoxville, Tennessee as part of a drive that I took across the country. And I want to spend just a moment introducing today's topic. I'm going to talk about Forex. I'm going to talk about even ETFs and stocks. The methodology that I'll share with you today applies across the board. This is a photo that I took in Knoxville, Tennessee. I drove across the country in April and stayed overnight with traders across America because I'm a nutball and I thought that would be a good idea. And here's what I heard all across the country. I want more trades. One guy told me, how can I get more deals? Like we were talking about used cars or something. Like more deals, more trades, more action. Action. That's the siren call that goes out to millions of traders every day. Keep moving or die. We're like sharks, right? When we don't smell blood in the water, we want to bite something. We're instigators. That's what I love about traders. That's why I love traders so much. Some of the greatest traders in the world, in fact, start trouble just so they can trade off of that trouble. Carl Icahn, the billionaire corporate raider, commonly buys a few percentage points of a company just to get them worried. And then he does get them worried, and then he bites, and the blood spills, and the other sharks come out. He's an instigator. And he's really a lot richer than the rest of us, but he's really no different. You're here because you want to make money, and I'm glad that you're here today, and I'm really super happy to meet you. You want to find more trades. Of course you want good trades. And of course, you've been to webinars before and seminars and conferences, and some guy like me is telling you that he invented candlesticks or translated the ancient Sanskrit tablets to bring you the secrets of trading from the 1st century spice routes. That's all bullshit, and you know it, and I know it. Just because I sell trading advice sometimes doesn't mean that I can't trade, but it does make it harder to believe. I accept that, and that's just the way it is. So today I want to tell you something. I'm not here to pitch you on anything or introduce you to the greatest thing that ever happened, and I'm not here to tell you that I'm smarter than anybody else. Today I just want to grab a wrench, and I want to pry open your brain, and I want to pour something special inside. I don't want anything else to get in the way of me helping you find more trades. I do all right already, and you're pretty close to making money consistently, and you're here because you already know something about trading and you want to get deeper into whatever it is that can help you. So that's what I want to do today. I started trading 14 years ago. I was broke. I owed $150,000 to the government and former clients. I failed in my first attempt at business after I finished law school, and I traded my way out of the mess. After my divorce in 2009, I was pretty much broke again. That kind of decimated me. It's no one's fault but my own, and I traded my way out of that one too. That's why I think trading's awesome. You can produce spectacular wealth in the markets, but it's damn hard, and you already know that. And educators like me will often scream platitudes at you. I guess we do this because some of us are worried that you might actually do what we teach you to do, and at least then we've got these platitudes to fall back on if things don't work out. I think you've heard enough of let's let your profits run and cut off your losers and have a plan. You probably just want to hear me go hardcore on technical analysis. So that's what we're going to do today. I'm going to teach you how to raise your win percentage. That's my goal today. What I'm about to tell you is, and this isn't an exaggeration, this is the best system that I've ever used and I've ever taught to anyone. I'm not going to hold anything back or keep it private or whatever else. I've never traded anything more successfully personally, even when I was a money manager and I ran my own fund. It's all based on hard rules that you can follow, and you can write them down today, and it works. And it doesn't break, and it keeps on working. And if you want to trade stocks, you want to trade ETFs, or you want to trade what I love, currencies, that would be absolutely fine with me. And we'll try to look at examples from every one of those markets. I implore you, however, to focus. In fact, I'm on the verge of begging you to focus. You know what? I am begging you to focus. I beg you to focus on one system and make it your own. Love it. Marry it. Be dedicated to it. Commit to it. Have 100 babies with it. With focus comes happiness, and with happiness when you trade comes peace of mind. And when you have peace of mind and some emotional stability, that's when the profits really roll in. Traders often think the system provides the profits. That's not exactly quite right, in my opinion. It's the focus on the system and the dedication and commitment to it. That's the true engine of profits, the ability not to switch everything up every time you see something new. So with that, I'm going to teach you my favorite trading system today. And it's the only one I use. and it's called the Knoxville trade. So welcome to Knoxville. I think a high win percentage makes a happy trader. That's just the way it is. I know that there's other ways to look at it. You could look at it with risk to reward ratios or a system you really like or whatever else. But I've never seen traders more happy when they win. And I know we're all supposed to get all emotionally stable and put down our crack pipes and not be so focused on winning all the time, and that's not the holy thing. But you know what? When I get up every day, I don't want to lose money. And when I start losing money, I start getting frustrated with my trading system, and then I change my trading system. And what happens when I change my trading system? Boom, right away, the next trade pops up that I'm not going to take now because I had a losing streak, and that's the winner. And then I want to just pound my head in with the hammer. It makes me mad. So I try to teach traders, at least especially recently, a trading system with a high probability of success. Sometimes you might have a 1-to-1 risk-to-reward ratio, and you might not want to throw a party for your stop loss and your profit target, but you can keep doing it. You're not going to jump away from it because at least you know it gives you some gratification. I mean, it's not enough to be in a relationship where the person's nice to you once a year. Even if they're really nice to you, it's not enough. And it's not enough to have a trading system that's only going to win occasionally. It's just not enough for me. My name's Rob. You've probably never met me before, and I'm happy to meet you, and I'm glad you're here, and I appreciate you spending some time with me. I'm the host of the Traders Podcast. We're in our 200th episode. I'm here in Salt Lake City for the weekend recording that episode. I'm also the founder of TFL 365, which is a daily signals and trade alert service for currency traders. I'm also the founder of Booker SFO, which is a trade alert service for stocks, ETFs, and futures traders. I'm also, and you probably don't know this, I'm also the owner and chief interviewer of TraderInterviews.com. Most people don't know that, and I'm here in Salt Lake also interviewing a very successful currency trader for the next episode of that. I'm also the creator of NLP for Traders, which is a DVD set about the psychology of trading using techniques in neuro-linguistic programming. I'm also the author of Adventures of a Currency Trader, which is a great substitute for Ambien and probably the most boring book ever published in the history of mankind. I've been trading for 14 years, and I absolutely love traders. I love you guys. I love traders. I'm not the smartest trader in the room. I'm not the best trader that ever lived. I make a living from doing it, and I think that's what you want to do as well. So that's exactly what we're here to do today. My forthcoming book is Man vs. Market, Lessons from Trading on the Road. It will be published in December. And it's the story of me driving across the country and staying with people like you and asking questions of them about how they are trying to succeed as a trader. Not everyone was successful, and we often talk so much about the super successful people that we forget that many people are in the trenches trying to make this work, and it's very difficult. That book comes out in December. I'll be giving that away for free to most people, and I'll tell you about that in a minute. But today I want to talk about boosting your win percentage substantially. I know a lot of you out there use eSignal. I know a lot of you out there use TradeStation or Thinkorswim. And if you're a currency trader, you probably use MetaTrader. And I'll tell you how to get everything that we talked about today. I'll just let you download it for free. And if you follow the link at the bottom of the screen, you can do that. What you're going to need today, though, to follow along with my presentation, in addition to like letting me just go really quickly because I have a lot of stuff to talk about, you're going to need the momentum indicator set to 20, and you're going to need the relative strength index set to 21. These are the core elements of Knoxville divergence, or the Knoxville trade. Knoxville divergence happens when a momentum divergence setup is accompanied or confirmed by overbought or oversold RSI. Let's take a look at Apple. Now we're going to look at examples from stocks, ETFs, and then we're going to take a moment and look at my favorite market, the currency market. But I know a lot of you here trade a bunch of different things, and I want to make sure that you get something out of this presentation that you can take home and you can use right now. On the screen in front of us is a 15-minute chart for Apple. I love the 15-minute chart. Everything that we're going to talk about is applicable to other time frames as well. On this 15-minute chart, you can see on the top screen where price is, you can see a red line underneath the candles. This designates price falling. Now, I know that's like super basic and you already knew that. So price is falling and making lower lows. You could say that that's a downward trend, but everybody here knows that over the course of the last few years, Apple's actually been in an uptrend. We're going to talk about divergence, but we're not necessarily talking about counter-trend trading. This is actually on the screen in front of you one of the ways that I bought Apple in the midst of its pretty significant incline. So this is not necessarily counter-trend trading. Even though it's divergence, this is a shorter time frame chart entry to go with the longer time frame chart trend. And that's a really important concept. The momentum indicator is mostly and widely available on everybody's platform, and it's absolutely free. So there's a momentum oscillator or an indicator, and if you play around with your charts long enough, you'll find it. I'm using on the screen, and for the purposes of our presentation today, TradingView.com charts. They're free, they're browser-based, they don't cost you anything, and you can follow along right with what we're doing in your browser as we go. Apple is falling. I drew a red line underneath price to show that. At the same time, though, the momentum indicator is rising or making higher lows. That's divergence. Now, divergence is a dime a dozen. Divergence is not a very good-looking person. You wouldn't want to ask it to the prom. You find it everywhere. It's pretty ordinary. It's a member of the chess club and stays home at night and plays Call of Duty or whatever. I don't know. It's not very interesting. Divergence on its own isn't really enough to base a trading decision upon, in my opinion. And I liked what was said earlier in the last presentation because there was some other elements that went along with divergence. That excites me. I wrote a whole book about divergence in 2010, and essentially the concept is divergence alone does not a trade make. We need something else in order to confirm or be added to the divergence to let us know that it's time to actually get in. Although Apple was in the midst of a longer-term bull trend when we saw this 15-minute chart, it was dropping. And I don't want to catch a falling knife. I think that's the funniest phrase in the whole world. Like, are there people that want to do that? They're idiots. Nobody wants to do that. Don't patronize me. I know we don't want to catch a falling knife. It doesn't mean, though, that I don't want to buy something that's in the midst of a bigger uptrend. I just want to be smart about it, right? I want to be smart about catching that uptrend, and that's what we're talking about today. Price is falling, momentum is rising. So momentum is making higher lows, price is making lower lows. That's an early warning sign that Apple wants to move up in the opposite direction. At the same time, and over the course of those same candles, inside of the stretch of candles that created that divergence, at the bottom of my screen, you can see a red arrow pointed at the RSI, Relative Strength Index, set to 21. The Relative Strength Index set to 21 dropped below 30. The 30 mark is traditionally viewed as oversold with the Relative Strength Index. A Relative Strength Index set to 21 is more difficult to get oversold. You don't see it go oversold as often because it's got a longer setting. It slows the indicator down and it makes price fall farther for a longer period of time before it can go oversold. This is Knoxville divergence. It's essentially a little play on standard divergence. Now, why is it called Knoxville divergence? Well, I was sitting in a coffee shop in Knoxville, Tennessee, and I've told this story before, but I was sitting there typing away on my computer thinking about divergence. And I was like sitting there at my computer, and this woman walked into the coffee shop, and she looked at me. And I was like, wow, that's a pretty nice looking woman or whatever. And of course, I didn't talk to her because I'm a total idiot. So she walked into the coffee shop, and she was walking out of the coffee shop, and she looked at me again. Did I talk to her? No, I didn't talk to her because I was smelly, and I'd been driving across the country, and I was kind of involved with somebody else, so I was going to really talk to her. And then she walked into the coffee shop a third time, and instead of having a revelation about relationships or women or something like that, I thought, oh my gosh, you know what I need to add is a third element to my divergence trades. Because I'm a nerd. And it was at that moment that I realized I could filter out or add some confirmation to my standard momentum divergence trades. And it took these divergence trades into a whole nother level of high probability that we'll talk about today. So that's the story behind why it's called Knoxville divergence. And it's the addition of other elements besides the divergence to tell us that this really means business. Apple is falling. Momentum is rising, and the relative strength index dropped below 30. That's Knoxville divergence. It's not an entry yet, but that's divergence. Today, I don't want you to obsess about risk-to-reward ratio. There are entire debates that happen on online discussion boards related to trading where somebody gets into a fist fight verbally with somebody else because the risk-to-reward ratio isn't good enough. I don't understand this kind of conversation. The goal is to make money. And as long as your win percentage is high and your risk-to-reward ratio is acceptable, like not terrible, then you're welcome to go ahead and take the trades. And that's what we're going to talk about today. We're not going to obsess about risk-to-reward ratio. These are all going to have risk-to-reward ratios that are 1-to-1 or better. So if you have a really high win percentage, this is going to do just fine. This is a presentation about increasing your win percentage. What's the story that's being told on a Knoxville divergence chart? Well, the story that's being told really brings us back to two keys that make high probability trading systems, and high probability in particular, Knoxville trades. And those two elements are as follows. Number one, you want to be selective. This sounds like a total platitude and an absolute cliche. We're about to look at like 40 charts and really dive into some hardcore technical analysis. But before we even get there, I want to remind you that this is about being selective. This is not about chasing the market. This is not about every day having, well, you are going to get a trade every day. I have so many trades, I don't know what to do with them every day. That's why I started the friggin' trade signals thing, because I got like 25 trades a day that pop up here, and I don't know what to do with all of them. I'm not going to take 25 trades a day. But even with that 25 trades that pop up, we're being selective. We're not just saying, oh my gosh, there's some movement, I got to take it. We never want to do that. We never want to look at the flashy, shiny object and chase after that. I'll tell you how we do that in a moment. But number two, after we are selective, when we find the one that fits the bill and we know it, we want to be aggressive. And this is the key to high probability trading as far as I'm concerned. You don't chase after everything, but when you find it, you pound on it and you crush it. Every single long-term successful trader that I've ever met, and I've probably talked to as many traders as anybody on planet Earth, every single one of the great traders didn't chase after the market, wasn't obsessed about the market, but when they found the trade they liked, they pounded on it, and they didn't hesitate. That's what I want to help you develop today in a very short period of time, I admit. That reluctancy to chase after everything and the aggressiveness to go for it and pull the trigger when it comes. It sounds kind of amazing, but I think that if you really hone in on selectivity and being aggressive, that you can increase your win percentage to stratospheric levels that are very uncommon. It's not easy to do, but I'm absolutely sure that it's possible. Once again, I think when you have a high win percentage, you are a happier trader. So let's talk about taking high probability Knoxville trades. We're going to talk about the stock market in Knoxville. We're going to talk about the currency market in Knoxville. We're going to talk about the ETF market in Knoxville. You can also do it with futures and blah, blah, blah. What you're going to need when we talk about stocks and ETFs is you're going to need Knoxville divergence, which is that momentum indicator and the relative strength index. And then you're also going to need another relative strength index set to 28. Let me show you what you need again so that I can remind you. And I'm sure you'll watch the recording of this presentation and you'll enjoy that. And if you're watching the recording, it's like, hey, how you doing? Thanks for watching the recording. You need the momentum indicator set to 20, and you need the relative strength index set to 21. That's what you're going to need first of all. Knoxville divergence happens when a momentum divergence setup is accompanied or confirmed by overbought or oversold RSI. So once again, Apple is falling, momentum is rising, the RSI went below 30 for oversold, that's Knoxville divergence. Or this is a Russell 2000 ETF, this is the IWM, you see price is rising, Russell 2000 is rising, but the momentum indicator is falling. And over the same stretch of time, in two different places where you see the circles, the relative strength index set to 21 went overbought. That's Knoxville divergence. That's number one on the list of things that we need to be selective. We need to wait for that to happen. I built an indicator to make it easier to see Knoxville divergence on a chart. Now, I give this indicator away. I don't charge for this indicator. We have it done for eSignal, TradeStation, Thinkorswim will be done on Monday, MetaTrader. I can't even name all the platforms. And I'll show you where you can just download it. I'll just give it to you. So I'm not here to tell you it's like $1 million or whatever. I built the indicator, and I'll tell you how to get it so it makes it easier to identify that momentum and RSI setup in combination. But I want to just blow through this stuff, and I don't have a ton of time, so I want to make sure we get through everything. I also added another, as I mentioned earlier, and we do have it for NinjaTrader. Yeah, I forgot to mention that. We also have it for NinjaTrader. I also added another relative strength index to the bottom of my charts. So in the end, when you get the Knoxville divergence indicator put on your charts, this is a chart for Rackspace, but it could be the British pound Canadian dollar, it could be the IWM, it could be the SPY or GLD. This is Rack. I love this stock. Rackspace 60-minute chart, and you see these red lines above and below price. Those are Knoxville divergences where the momentum and the RSI combine to make either bearish divergence or bullish divergence. And I don't have to plot all that crap on my charts. It will just draw the lines automatically. And like I said, I'll show you where you can go and get this automatically. If you use tradingview.com, it's a subscription, but for every other platform, we just give it away. And I will tell you how to get it. So don't ask me again. Everybody, I'm going to take good care of you. Everything's going to be okay. So the Knoxville divergence is designated by the red lines on the chart that you see on the screen. And at the bottom of my screen, you can see a relative strength index set to a ridiculous 28. You're going to need this 28 RSI at the bottom of your screen, so get it up on your screen. In addition to the 21, if you have to have 2 RSIs, that's fine. You're going to need this in order to take the trade. Knoxville divergence already had the RSI set to 21 in the formation, so you're actually adding another RSI to the mix for the purpose of entering the trades. Here's how we take an entry. Now we're going to get into how the trading system works. Number 1, you get Knoxville divergence on a 15-minute chart, and then you get the relative strength index set to 28, goes above 60 or below 40. Let's look at a ton of examples. This is Rackspace hosting once again on the 60-minute chart. We looked at this just a moment ago, and you can see all of these bearish divergences. On my screen here, I don't know if you can see my cursor circling, but right now my cursor is circling to the left upper portion of the screen, and I'm showing you where all these red lines are on top of the candles or the bars. Then you see a yellow circle around price. What is that yellow circle telling us? That yellow circle is telling us that after this Knoxville bearish divergence, we saw the RSI, the relative strength index, set to 28, fall below 40. That's a sell trade. We put the stop loss above the highs, and we'll talk about profit targets in a minute, but I just want to hammer home how you enter one of these trades. I can't even contain my excitement about this. Like I scan hundreds of charts every day to find these trades, and I absolutely love this methodology. So this is a Rackspace sell trade. You could buy a put, and we'll talk about that in a moment, or you could just outright sell the stock, or you could look for just buy trades, or whatever you want to do. If it's a currency or a futures contract, it's easy just to sell it. But at this moment, when the RSI set to 28 falls below 40, that's the key. Like what happened is we had divergence, we knew it was primed for a fall, but we couldn't sell it until the RSI dropped below 40. Why do we care about that? What's happening? Some people will tell you, oh, the big boys are all selling, or some bank did blah, blah, blah. I don't care about any of that. I care about the statistical significance of it. It just works. I don't care why it works. I don't care if Prince Charles decided he wanted to sell Rackspace. I don't care. I don't care if the Wisconsin Bicycle Index came out and it came in lower than expected and that affected Rackspace. I don't care. I don't care. I care about probabilities. Hey, heck, I would love it if also at that time Rackspace had a virus. I'd be thrilled about that if the fundamentals confirmed it, but I'm not going to wait for that. That's a sell trade, and it's a sell trade now. Stop loss above the highs. We'll get to the profit target a little bit later. I want you to consider, if you're looking at the stock market, we're in a pretty good bullish cycle right now. And I would like you to consider only buying, not selling. Everybody I used to have a brown bag lunch back in the late 90s with hedge fund managers in San Francisco, one of which was profiled in Stock Market Wizards. I'm not going to tell you who it was. All right, it was Dana Galante. And so my ex-wife worked for Bear Stearns, and so I met Dana, and she was a short seller, and she was really successful. But she worked for a firm that in one day lost $120 million on OEX options because they were betting that the NASDAQ was going to fall. And the tech trend, the technology bubble was going to pop. And they lost $120 million trying to pick that. I don't think that's a great idea. I think that's a pretty dumb idea. We're not looking for the big score. We're looking for consistent, repeatable success. We're not looking to get into our high school yearbook as most likely to time the market's turn. We're not trying to be W.W. Gann or Nostradamus. We don't care about that. Right now, the economy's doing okay. You could hate Obama or love him. I don't care. It looks like people think the economy's all right. So I want you to consider maybe when it comes to stocks, just buying. ETFs, you can sell it also. futures you can do buys and sells, and currencies you can do buys and sells. I want you to be selective. Try to trade companies with liquidity, earnings, good management, growth, all that kind of stuff. I know that sounds like, well, I already knew that. But when it comes to these Knoxville trades that you're going to buy, just be smart about it. Don't buy Groupon. We're not going to do that. Like, we're not looking to buy pets.com, okay? We're looking to trade like the Investors Business Daily 50. Pull that paper out, look at the 50 stocks they like, and just look for these setups on those stocks. We're going to get to a lot more stuff, but let's look at a bunch of examples now. Let's get deeper into what these trades look like. On the left-hand side of this screen right here, you can see Rackspace hosting on the 60-minute chart. So Racks is falling, and there's all kinds of divergences. Remember, divergences are a dime a dozen. We don't care about it until we care that there's an early warning sign that Racks is going to come back up. So we think that it's going to come back up, but first we need to see the RSI set to 28 rise above 60. Boom shakalaka, it does that. You see it go above that red line right there. That red line at the bottom of my screen marks the 60 level on the relative strength index. As soon as that candle closes and Rackspace rises enough to go above 60, we've broken that downward trend. There's a chink in the armor, there's a crack in the system. Somebody thinks that Racks is a deal. They say, oh man, that's a deal. This could be a currency pair, this could be crude oil, this could be beans. I don't give a crap what it is. This is an indication that we're ready to jump up again, and that's a buy. Stop loss goes below the absolute lowest low that was made when the divergence setup occurred, like $1, a cent, a penny, I don't care. At the low is fine, and we'll talk about profit targets in a moment. This is Netflix. Boy, do I. Yes, I wait for a candle to close. I wait for a candle to close. This is Netflix. I love this company. I loved this company when everybody hated it. I was a subscriber when everybody hated it. I just rented DVDs for them just to prove that I didn't care what people thought about it. I thought this was the greatest company in the whole world, and I still do. I love this company. I watched the whole Sopranos, or what did I watch? I don't remember what I watched. I watched so many series on Netflix. I have wasted so much of my life with this company. So that's a company worth trading. Here's Netflix on the 60-minute chart. You see bearish divergence. These red lines on the top of my screen are Knoxville divergences that I don't need to show all the indicators that go into it. So the momentum is hidden, the RSI set to 21 is all wrapped up inside of these lines. It's all there for me already. At the bottom of my screen, I see the RSI set to 28, and you can see where there's that circle there and an arrow pointing to it. Netflix dropped far enough after the divergence to make the RSI set to 28 go below 40. That's a sell. This is Caterpillar on the 15-minute chart. There's bullish divergence over here to the left. I don't care if there's lots of divergences. I don't care if the slope is deep or the angle is sharp. I don't care. I don't care anything about it. I just care that that's divergent. And then off to the right, a few days later, on this 15-minute chart, the RSI set to 28 rises above 60 in that yellow circle. That's a buy trade when the candle closes. Now you can see that price immediately drops. You might say, wow, that's terrible. No, it's great because you could miss this trade and then get a better price. That's awesome. That's super awesome. Lots of times on these trades, I just let the entry pass and then I wait for a better price. It doesn't matter what the RSI does after this. It doesn't matter. The RSI now, as far as I'm concerned, can go to friggin' Paris, France on a vacation. I don't care where it goes. It could go sideways, it could go up, it could go down, it could go back below 60. I don't give a damn. I don't care what it does. I have thrown away the RSI out of my mind now. It's like, thank you for the entry. Your work here is done. You can leave early. Here's Caterpillar on a 15-minute chart. It's just another example. Divergence, bullish divergence off to the left, and then price goes far enough up that the RSI set to 28 goes above 60. This could be the Euro-US dollar. It could be CL. It could be the S&P E-minis. It could be SPY. It could be anything you want to trade. Boom shakalaka, we are ready for a trade here. We're going to buy it now. This is another 15-minute chart. They all look the same, right? These are all consecutive trades. They all look similar. Divergence. And then the RSI set to 28 goes above 60. Boom. Upward movement. Stop loss goes always goes below the absolute lows that were made when the divergent setup occurred. And we'll talk about profit targets in a minute. This is Citigroup, 15-minute chart. Now, I wouldn't call Citigroup but a Class A company with earnings and good management, but let's just look at this anyway. Here's bullish divergence off to the left. So these red lines underneath price designate that multiple times Citigroup had fallen and created a bullish divergence, but we didn't go for it. We didn't take the bait. Why? Because try as it might, it couldn't get above 60 on the RSI. Look at it over here. It acts as a type of resistance. And then all of a sudden, boom, we jump upward, probably on earnings or some announcement that, I don't know, who cares? And it jumps above 60 and we're buyers. We wait for the candle to close and we're buyers. Stop loss goes below the absolute lows and let's go for a ride. This is another 15-minute chart of Citigroup. It drops, it creates bullish divergence, red lines underneath the candles. RSI jumps above 60. You can see it didn't do that before. It didn't jump above 60 over here. It didn't do it. It couldn't do it. And then it finally does go above 60, and that's the buy trade on the candle close. This is another 15-minute chart. Someone says, what do you mean when you wait for the candle to close? I wait for that 15-minute bar to complete forming. So you would only take a trade on the hour, the 15-minute, the 30-minute, the 45-minute, or the hour. Because RSI can jump above 60 while the candle is forming, but then drop back down below it, the candle closes, and the RSI is no longer above 60. Okay, so that's a buy trade. Stop loss goes below the absolute lows. We'll talk about profit targets in a few minutes. This is Google. So Google was in an uptrend, and it dropped. Every uptrend has to have retracements, you know, like impulse and correction, or whatever it is. So you're not counter trend trading here necessarily. But on a shorter time frame chart with Google, I was stalking this trade for quite a while. And on the Trade Alert service, when I first launched it, this was one of the first trades that we took, was a buy trade on Google. We bought 900 October 19 calls on Google. And because of this, we had bullish divergence, and then the RSI jumped above 60. The candle closed, and we were in. And then we were in that trade. So we chose a strike price that was, we usually choose a strike price that's within 10% of the current price if we can, and at the next expiration on a 15-minute chart. So at least 2 to 3 weeks out, if not 2 to 6 weeks out is fine. And then we just hold on to that for dear life. And then the most we can lose is like what we bought the option for. We're not doing spreads and condors and friggin' I don't understand any of that stuff. I just like the probability that it's going up. Simplification. No complexification of what we're doing. This is Google on the 15-minute chart as well. There's bullish divergence. So there's all these, look at all these divergences. It's like divergence is all over the place. Divergence is all over the place. Price jumps up. The RSI 28 goes above 60, and we buy. You can do this on a 60-minute chart. I'm going to look at 4-hour charts. I'm going to show you, I don't know if I'll show you any daily charts today, but I got a bunch of those too. It doesn't matter the time frame. Time frame is irrelevant. I'm just looking at 15-minute charts. This is Facebook. Everybody hated this for a while. I couldn't understand why. They have like 1 billion customers. I mean, hello, they have 1 billion customers. What's your problem? Anyway, bullish divergence. So red line underneath the candles, and then the RSI goes above 28. Above 60. That's a buy trade. This is Facebook again on the 60-minute chart. Bullish divergence, so these red lines underneath price are designating that price is falling, the momentum is rising, and that the RSI was oversold. Price jumps up, there's a gap. Is the gap going to be filled? I don't think so. I'm not going to go nuts over a gap. Fine, it gapped. I'm thrilled that it gapped. That's fine. I might wait for a better price. But the RSI went above 60. That's a buy. That's a buy on Facebook. I didn't care, at this point, I didn't care what anybody said about Facebook. Holy moly, if you have 1 billion potential customers, they will figure it out. Like, if they have to start selling porn, they're going to do it. Like, it's going to make money. Facebook is going to be fine. All right, this is Micron. I don't even remember what Micron does anymore, but when I was in college, when I was in Utah, I would drive up and down between Provo and Salt Lake, and I would see Micron plant. And I was like making this presentation. I was like, oh, Micron. I was just thinking about it. I don't know anything about this. I don't know anything about this stock in particular, but it goes bullish divergence. We get the RSI above 60, and we buy. Let's just move on and show you. This is like it just goes on and on and on. 15-minute Google. What about ETFs and indexes? Let's look at those. We'll take a few moments and look at those, and then we'll also look at currencies as well. So what if you like ETFs and indexes? So this is the Russell 1000. This is the IWB. Boy, I love the IWB and the IW. I love it. What we have is bullish divergence. So these red lines underneath the candles. And remember, I'll show you how to get the indicators and blah, blah, blah. And then price moves above the 60 mark on the RSI. There's a gap, but I don't care. I don't care that there's a gap. That doesn't bother me. I don't care that there's a gap. That's a buy trade. As soon as that candle forms and it's done and the RSI stays above 60, that's a buy trade for me. And then it's off to the races. This is the SPY. I love the SPY on this. Someone asked me what my favorite time frame chart is. I love the 15-minute chart, especially for options, because I can trade an option with an expiration that's like 2 to 6 weeks out and a strike price that's within 5% of the current price. I can get that reasonably good. The S&P has like great spreads, and it's totally awesome. So I love this one. The bullish divergence followed by the RSI jumping above 60. You buy it, you're good to go. This is another one. This is a sell. You could buy a put here. So you see bearish divergence followed by the RSI dropping below 40, and that's a sell trade. Let's talk about profit targets. So we haven't talked about profit targets up until now. The red line above the price on the screen here, that's the stop loss. All of these trades always have a stop loss beyond the highs or beyond the lows, always. And you could be at the lows. There's not a numerical number. It's not like 1% or 2% or 5 cents or whatever. Just put it there. If it goes all the way back up there, you're dead. It's not going to work. So it's over. And there's no magic to that. There's no magic formula. What about the profit target, however? I like as a primary profit target for high probability trades, meaning trades with a 70 to 90% win rate, depending on the instrument that we're watching. I like using divergence in the opposite direction as the target. So when divergence sets up in the opposite direction, I want to get out of that trade or take all of my trade off the table, take part of my trade off the table and let the rest of it run, or move my stop loss to break even. Now, if you don't know what those terms mean, you can look them up on the recording. You can pause this and look those terms up. They're all pretty standard. I don't need to see divergence on the RSI set to 28. I already used the Knoxville divergence. So these red lines on the top of the bars and candles over here designate that I'm about to sell. The circle is where I sold, and then there pops up a Knoxville divergence in the opposite direction below the candles. That's where I want to take some of my profit off the table, all of my profit off the table, or move my stop loss to break even and let it run. This is another SPY. Get bullish divergence followed by the RSI going above 60. And then very quickly we get divergence in the opposite direction and we say, man, I didn't make enough money here. Oh, I don't want to get out of this trade. But you do. You do it anyway. You move to break even, you take some of your profits, or you get out of the whole damn thing. And maybe you just made 0.5% in a half of a day. And maybe that's the best you can do. Fine with me. I don't have a problem with that. There's another example of, it's in the middle of the screen. You see bullish divergence over here, a red line underneath price to designate the stop loss. Buy it when it pops above 60, and that's it. Someone's saying, could you tell me when you use the RSI set to 28? Remember, watch the recording and follow me here. The divergence is plotted using momentum and relative strength index set to 21. The entry comes from the RSI set to 28. That's only for the entry. Okay, what about longer term and bigger profit setups with Knoxville? What about that? Here's a 4-hour GLD chart. I love this ETF. I think this is the greatest ETF ever made by anybody of all time and forever. So we have bearish divergences at the top of the screen here. That's awesome. And then we have a sell trade that comes when the RSI set to 28 falls below 40. You buy a put or you sell it, you move to break even or lock in some profit where you see that red arrow, and then you can ride it for a longer period of time. Here's a bullish chart, 4-hour bullish divergence. So the red lines are underneath the price. And then we use the 28 period RSI when it goes above 60 and we buy it. We lock in some profit or we close it out after that move. That's a move from 160 to 167. So I don't know about you, but that's like a 0.75% in about, I really don't know, like a few weeks. That's fine. I'll take that every time. And you could lock in the profit and then ride it for a little bit longer, and you do much better than that. You get like $12. That's awesome. This is a 4-hour chart. Again, it's like every single one of these I could find right before we started the webinar. I was like, we got to look at some long-term charts. So we get bearish divergence at the top of the screen here on the left. We have the RSI dropping below 40 for a sell. And then over here to the far right, we lock in some profit or close the trade when we get divergence that pops up in the opposite direction. That one only moves about $8 or not even that, $5, $8, whatever. It's not as big of a move. And we just have to say, okay, I'm going to lock in some profit, move to break even, and get out. Okay, you can also trade credit companies with Knoxville. You can also trade, you could trade all kinds of, you can trade penny stocks with Knoxville. You can do a lot of stuff. But let's switch over here for a moment, and let me bring up a list of currencies. Let's look at some currencies as well. And I'll look at your questions as well. Hold your questions. I'll have some time for questions. So no sweat on the questions. Don't worry one bit. See if I can bring up some of these recently closed trades. Okay, these are some recently closed trades on currencies. So if you're a currency trader, you could see bearish divergence on these red lines, and then a sell trade where you see this horizontal line, and then it falls and reaches the target. And most of this is all built in. Someone said they don't know how to read Knoxville divergence. It's pretty easy. Oh, you don't see my chart? No problem. Watch this. We'll share my screen. All right, you should be able to see it now. There you go. Looking at a dollar-yen chart. Let's look at a better example here. And someone said, I don't know how to read your Knoxville divergence. Let's use a currency chart here, and I'll teach you once again how to read Knoxville divergence. Pay attention. Like, it's totally, I'm here for you, and I'm glad you asked me the question. Totally awesome. So let's take a look here. We have divergence over here. These lines above price, friends, designate that this currency pair is ready for a drop. It's ready, but we don't just jump in and sell it like a bunch of smoking monkeys. We're not going to do that. We sell it. Someone says they don't see my stuff. Let's just make sure. Let me make sure. Can anybody tell me if you can see my screen? Can you tell me if you can or can't? I want to just pause for a minute here and make sure you can see it. Oh, you can see it. All right. Thanks, Joe. You win. Awesome. Okay. Let's go back here to my screen. So this bearish divergence designates that we're ready for a drop. And then price breaks below that 40 on the RSI, 40 mark. It's just designated by this horizontal line. And we sold the Euro Canadian, and that was 105 pip or 105 point. These are all of these trades that we've looked at are just from the other day, just from a couple days ago. This is October 31st. We bought the CAD Swiss, for example, at 86.19, got it at 86.50, and some of us rode that a little bit longer. I tried to get everybody to ride it a little bit longer. But we had divergence over here at the left, these lines underneath price, and all of it's built into the indicator. So this is a really clean, easy to see chart. This is the Canadian dollar Swiss franc on a 60-minute time frame. There's bullish divergence right here. And I'll just pull up, let's just go hardcore here. And we'll just pull up the CAD Swiss, for example. Let's see. We're looking at moon phases chart? Nah, let's not look at moon phases. Let's look at Knoxville 60-minute chart. And I'll break one of these down for you. Oh, this is the British pound Canadian dollar. So beautiful. All right, this is the British pound Canadian dollar. I will break this down step by step for you. That will probably help you see how all of this fits together. And we'll see if we can refresh the screen and get that RSI to show up. Yeah, the RSI condition can trigger after the divergence setup. And we'll see if it won't show up on the CAD Swiss. We'll see if it'll show up. I don't know why the RSI isn't showing up there at the bottom of my screen. That is totally ridiculous. I can make it show up. Let's do this. Let's see if RSI will show up here. There we go. Perfect. We'll go back to the 1 hour. And I want to break down a trade for you right here. Okay, here we go. I'm going to break this trade down for you step by step. Number one, we see divergence. You can get this indicator on TradingView. I'll show you a website where you can download the indicator for free. So we know that this divergence is here automatically. We got it. We drew it for us. And then the RSI set to 28 goes above 60. And that's a buy trade right here. Some people missed it, so I planned another buy trade for everybody around this level over here to the right. But this is a Knoxville divergence buy trade on the currency market. And this happens repeatedly over and over and over again on just about any kind of instrument that you want to watch. Here's divergence, but we didn't sell it. We didn't bite on any of that until the RSI dropped below 60, right there. And then the British pound Canadian dollar just dropped like a rock. And I don't care what we look. You want to look at the pound New Zealand? We look at the pound New Zealand. Like all kinds of wild, weird, esoteric currencies. So we have divergence over here. And then the RSI set to 28 goes below 40. These red and green arrows that you can see here, that's another indicator that I use. We don't have time to talk about that today. We just don't have time for that. Now, how are you going to get the indicator? Let's see if I don't even know if I have a slide on this. Okay, so if you go to, I'll just go over to that website right now. It's bookersfo.com. BOOKERSFO.com. I'll leave it up on the screen for a moment. You can go to that website, and I'll just give you the indicator. So there's the class. Here's the form. You just like put your email address in here and your name, and I will send you the code files for TradeStation, Thinkorswim, eSignal, NinjaTrader, MetaTrader. I'll send it to you for all of those. I think that works. My name is Rob, and my email address is, I'll just put in a fake email address. That should work. Yeah. So that gives you a welcome message or whatever. And I've had a great time with you today. So I'm going to stop sharing my desktop. Stop sharing, and I'm going to come over here to the questions panel, and I'll just look for some questions or whatever. I just want to say thank you to Fausto and thank you to everybody that was here. I've had a really great time. If you sign up for that email list and I don't have the indicator for your platform, you just let me know what your platform is. I'll see if I can find somebody and pay someone to program it for you so you can have it on your screen as well. And yes, of course, I have it for MetaTrader, and it's awesome. And yes, this has been recorded. I do not use volume, but you're welcome to, Charles. It's a great indicator. I have a whole presentation we could talk about. Thinkorswim, yeah, it's in the process of being finished right now. Really appreciated you guys coming down. If you want it for Sierra charts, just write me a message and tell me just tell me you want to get it for your platform. I trade on a Mac. I chart from a Mac, and I use TradingView.com charts, and they're awesome. They work just fine. Do I use the cloud? Yeah, I still use the cloud, but today this was the highest probability thing that I could possibly even talk to you. How did I make up the RSI values? Did like 4 months of sitting in my office doing nothing else but building this. And once again, you can go to, if you want to download that, you can go to bookersfo.com. Do the brokers call it the Knoxville indicator? No, it's just me. It's just me. So thanks, everybody. I had a great time with you. I really appreciate you being here. And I appreciate Fausto and the Cyber Trading University folks for inviting me. I'm kind of a pain in the butt, and I really appreciate you guys putting up with me. I really do appreciate the invite. I love you guys. I'm so grateful that I have a chance to talk to you today. I hope you have the greatest weekend of all time and forever. Thanks, everybody.